This is a video about project finance modeling and the coronavirus. It's really about any kind of crisis. And when I made another video, oh no, I made another video about this, and I'm giving a webinar. And they asked me to include both uh, project finance modeling and corporate finance modeling. Now, I'm terrified of this stupid webinar because they're going to make me show my face. And I have very little hair left, but my little hair that I do have is kind of going a little crazy with this virus thing. So, whatever, I'm not going to show you my face on this video, that's for sure. So, what I'm going to talk about is an overview of some issues that could happen in project finance. Project finance is a little less interesting, perhaps, than corporate finance. And I'm going to, again, show you how to perhaps add some sudden shocks, like for the oil price, and how to make a month, if you have a semi-annual model, how to make little flags to make it work with a monthly model. It doesn't seem like that exciting, but it is. And now I get to go into detail. You know, this PLCR, project life coverage ratio, not DSCR, debt service coverage ratio, not LLCR. If you hear some background noise, I'm sorry. I'm locked up in this house during the crisis. The how you can use the PLCR in credit analysis has been a subject that's interesting to me for a long time. And people compute the LLCR, loan life coverage ratio, DSCR, all the time, but not the PLCR. Sorry about the background noise. And I'm also going to show you what happened in the last 2008 crisis. These banks wished that they had put cash sweeps in there for you. And as soon as they have to restructure, they're going to ask for cash sweeps. And I want to show you kind of some of the issues with cash sweeps, both the incentive issues, the mechanical issues, and how maybe you can mitigate some of those issues. And then I'll show you some of the mechanics of a project finance model, and certainly include how to model the defaults and the repayment of defaults that you don't see in models, but you absolutely should. Okay, so here's the I'm also, by the way, having another lecture, so I'm going to talk about some general project finance issues. This might go on a little bit long, so I'm not so worried about it. I'm going to talk about how, if you're just a student looking at this for the first time, WAC is what a crap calculation. What a crap calculation. Because the risk changes and the capital structure changes. And that, in project finance, financing, debt financing is really a big driver of value, and why we measure the IRR and how you use DSCRs, LLCR, and PLCR in credit analysis, and how to crucially understand the difference between a model that's made for structuring debt and a model that's made for risk analysis. So, this is not part of my coronavirus, but this is one of the best ways to learn project finance is really working through a model from A to Z. That's what people really should do. Oh, sorry, I said Z. I'm not showing that I'm really English. My other reason for these hell interviews, this is a fairly simple model, but I'm trying to go through A to Z, so I'm going to maybe perhaps do a second interview for that. Here's some examples of what could go wrong with a crisis. People don't drive as much. People don't take any planes. So if you have an airport or a road or that's not does not have a availability payment, but is an output based project, the cash flow is going to fall. A lot worse if you have commodity price issues with oil and gas prices and reserve-based loans, either project finance or a close cousin. What happens if you're building a big project and the people don't want to sit around and get the virus from each other? You're going to have a delay, and the cost might go up. And who pays the liquid? Is there liquidated damages paid by the EPC contractor? Who knows? I don't know. You tell me. And what happens if the off-taker says, I can't collect any money from my customers anymore, so I'm not going to pay? And maybe the most interesting issue is what happens if you have some assets and you want to measure the effect of the assets, hospital, a hotel, whatever, a plane. What's the real effect on the value of a single asset? And any corporation is a portfolio of assets. Now, I'm not doing this one. This is my favorite little thing to do these days is to make a diagram of project finance. In this case, the sun doesn't have you can't mitigate really against sunlight. People have talked about it. And you have to look at off-taker risk, and then you can evaluate all the drivers with your little spinner boxes, put different debt structures in, and see what happens for me, and put the one graph that I only care about, which is the graph of cash flow and debt service. So let's look at a couple of things. In the 2008 crisis, this is kind of interesting. I just found this by accident, whatever. It shows that there's a big dip and then a rebound. This was airline traffic. I remember, God, it was great taking those airlines in 2008, sitting with nobody else there. This is what's happened to oil prices. Oh my gosh, look at the oil price decline. You all know that. What's kind of more interesting is the gas price decline in Europe. Here's the oil price decline and the gas price. Now, these things I've got a commodity price database you can find on the website, and this one is like that stock price database, but you can start with oil prices, compare the oil prices to the stock prices and all that. And this is daily, this is monthly, so I don't really have the very last effects of that. This is the U.S. gas price. In this case, the U.S. versus the European gas price. And look how closely they've become. There was this big gap from the shale gas, and now they've kind of converged. It's fascinating. European industry will be more competitive if that stays. Okay, so I'm going to walk through some of these issues with a project finance model, and I'm going to try to do the same thing. I'm going to go back and forth from the PowerPoint slide to the model, and I want to understand there's the same kind of thing. We want to make a scenario analysis, understand how much you lose in cash flow, compute defaults, see what happens to the PLCR, see what happens if you put a cash sweep in. So let's go through some scenario principles again. Okay, I'm going to use a separate scenario page. A couple of times we might have to use the choose command. I'm going to compare the non-price crisis to the crisis scenario. I'm going to add in some other variables. Okay, here's how I've set it up. Now I'm going to go to my model. Now I hope, this generic macro setup, because I'm going to color this stuff while I'm doing it. Now I'm going to save this and then resave it as what colors. Okay, so the first thing I did, well, not the first thing to explain is that we have a separate scenario. And I wanted to make sure in this scenario analysis that here I modeled kind of our sudden decline in oil price, and this is month by month, and the same kind of thing. How long does it take to get back? You hope it gets back to kind of normal. Now, if you have something like this, I'm just going to color the sheet again, and I hope it does it all. Okay, I hope I have all the things set up correctly. Okay, and I'll do some of this. I'm not putting the coloring of the whatever. If you don't use this generic macro, please use it. Come on, so these are different scenarios. And then I have kind of an overall scenario that's as usual as a scenario number, and as usual also I attached a macro to this thing that I describe a hell of a lot elsewhere, where I copy things that come out of the index function. We use a little index function up here, and I copy the things when I change. So if I change back to the base case, this little line number 16 changes. Okay, and then I have some other time series. These are all the variables that are scalar variables, constant variables, whatever you want to call them. And on all these variables, I want to allow, up here, I want to allow you these ones. I want to allow you to change these variables, and that's what that thing does. And then if I change it back to the downside case, everything changes. And when I change it back to the base case, it puts this variable back to where it started, all that stuff that I explained elsewhere. Okay, and you can look at the file, of course. Then we have a time series variable, and that's just our price. This is like a merchant price case, which might be unrealistic for solar, but whatever. It has a few different scenarios. In this case, I would like to change this, and this bottom index function, again, this is what we use, and this depends on the scenario number. But if I want to kind of reset everything, I go back to the downside case, go back to the base case, it resets this scenario number. This scenario comes from this thing, and it can be changed either by that or the overall scenario. So that's a little bit about the scenario analysis. Okay, a little bit how I set up this. So I have a little diagram. And then with the scenario analysis, now I also added these declines and recovery kind of period. So let's show you how that works. But there's a little bit of a trick. So let me first go and illustrate kind of how it could start. I'm stuttering because I'm a little nervous. Okay, we have our base case here. We got a 9% equity IRR. We targeted a DSCR of 1.4 with sculpting and structuring, and I purposely made this go up and down and up and down and up and down like that, so you can see the effect of sculpting. You can see why in solar, okay, you really need this. If we started, and I'm going to show you a little bit later, if I started in April instead, and then I have to unfix this, sorry. Then the sculpting looks different. Let's put it back to February. Okay, that's because I've got a 6-month period, and we want to make sure the sculpting all happens very, very automatically. Now, okay, if I want to run a different case, I've sized the debt. This is how I've sized the debt. I could perhaps size the debt based on a P90 case. That gives me a lower amount of debt. But once I once I figure out how much debt comes from the cash flow, then I can do the first thing, which is fix the debt, and then use the fixed debt for our analysis. So this is a little bit of a tricky part, and then I can apply the crisis assumptions, and what I have here is a decline, and then interest that I pay on a default, that's a little gray area, and then a yellow area. So that's how we could look at this, and then we have to evaluate what happens. Can I continue repaying if I went really crazy here? And I kept pushing this down and down and down and down. Let me keep pushing it down. Then eventually you get to a point where you cannot repay the default. I'm looking at that key line. So this is kind of how to use a model in credit analysis. Now I've messed up all these variables, so I put it to the downside, put it back to the base case, and it resets everything to the base case for me. And of course I can unclick that. And that's just a true false little thing and I'll explain that I think I'm going to have a part 2, mechanical part of this. I just decided that while I'm doing this because otherwise it's going to take a little bit of long time. So that's an illustration of the kind of how to set up the scenario. Now the key thing in the scenarios is that when we go to this this kind of crisis, we definitely want to model this on a monthly basis. But if I go to my operating model, the first thing I absolutely have to do is color the sheet. Okay, that's crucial. Okay, and I'm gonna do it, I hope. Come on, come on, come on. Now I'm really, oh, it's taking a second because it's coloring all the links to other sheets. That's okay. Now what I'm going to show you here when it's finished coloring here, I put a little thing on the top for us. And then the key thing here, and this is something that's really important to me, this modeling is semi-annual. You notice it's a semi-annual model. Duh, I've said that twice now. Okay, and if it's a semi-annual model, and I would like to know which month in October, because I want to apply those prices in different months, I've got to know how much I'm producing in October and then multiply it by the reduced price. And I hate doing this kind of thing because depending on if the start date is ahead of the end date and all this. And I suggest making a little thing called a user-defined function for find month. And for me, this is a really big deal. It's such a big deal that I put it on my website, and I really tried to explain it. And you have to make a little bit of a program to figure out when this month really appears. You can do a whole bunch of formulas and make the tens of a whole lot of lines, but that's key, because once you have that, then you can see how much generation you have in each month. And then, most importantly, when you get down to the revenues, you can put the monthly revenues here. And if I put a crisis period in here, now what I should have done really is copy this little switch that says apply the crisis. Without the crisis, there's simply these numbers. Let me start again. So here's how you do it. I'm practicing because I really screwed up just now. Without the crisis, you just take the prices and you just multiply the prices by the total generation or the total output. No big deal. With the crisis, when I put apply crisis assumptions in, now you can see that these prices vary month by month. And that month by month price, it just comes from a lookup. Don't ever use match and index. Don't ever use it. Or VLOOKUP or HLOOKUP. Use lookup. It's so much faster. So much faster. And then you can see kind of how with the crisis, how things come down. And then you can click on this thing. I'm sorry, I screamed just now. And here was our crisis period over here, right? And when we apply it, we kind of put the things. I can't remember what day it is, what month it is. I can't even remember the year it is anymore. Oh God, is it my senility or is it the crisis? I really am going crazy, but I was crazy before. Okay, so that's the how we apply some of this. And I've got to get that a little smoother. Now let me talk about some credit analysis. And if you have a DSCR, and in project finance, if you know, that's the debt service coverage ratio. That's the total cash flow divided by the debt service, and that measures the buffer you have for the risks. But it doesn't really account for dramatic risk. The DSCR, the nice thing about the DSCR, you can see how much cash flow reduction you can occur. So if the DSCR is 2.0, let me do it 2.0, that means the cash flow is 200, the debt service is 100, and the cash flow can go down from 200 to 100. That's a decline of 50%. And you can use the formula 2 minus 1 is 1, divided by 2 is 50%. That's that formula. You can also go backwards and see what if you have a cash flow reduction of 50%. That's 1 minus 0.5. That's 0.5. 1 divided by 0.5 is 2. You can go the other way with the DSCR. Now the PLCR, traditionally people compute the LLCR. The LLCR, the way I think of it, is just the DSCR over the debt life. It's the cash flow, the PV of the cash flows. You need to use a discount rate. That's the debt rate. And the LLCR can be kind of computed like a DSCR over the life of the debt. And you can use that same cash flow reduction kind of formula. How much can the cash flow go down and not pay off the debt every single year, but year by year? The PLCR, now that's a little more interesting. People don't use it. It's the net present value of the cash flow divided by the net present value of the debt service, which is like the formula for DSCR over the whole life. Okay, but what it really does, we need to use the discount rate if the PLCR is below 1. You can't repay the loan after you restructure it. There's not enough cash flow to pay off the loan. That's what it's good for. And we can compute the effect of this crisis on the net present value of the cash flow and see if you can still be able to restructure the loan after the crisis. This percent decline in cash flow, should say percent decline in cash flow. I'm going to go back and fix this. It's one, just like it was for the DSCR, it's 1 minus the PLCR divided by the PLCR. Now, to illustrate how this works a little bit, I used a case here. And in this case, the PLCR was 2.26, and that comes from the tail. That comes from this thing over here. And then what we can do is keep pushing down our cash flow. I'm going to push down my cash flow and see how low my cash flow can go until I cannot pay back the debt. And these are the kind of things perhaps you should put in the modeling. So I'm going to do that again. What I'm going to do is put in up here, I'm going to fix this. I'm back to the base case, and now I can say, okay, here's the PLCR. This kind, it's a little bit different case than I have in the slides. I'm going to keep pushing this down, and I can see how low can my cash flow go down. And when this DSCR gets down all the way to 1, up here, I've had a default. This is a default, and then I'm trying to repay the default. And let's keep pushing it down. Now I have a bigger default, and I still have room. And when I keep pushing it down and 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 down, and oops, I'm just about there, and the PLCR is just about 1. So the PLCR, when it's exactly 1, I've just pushed it down. If it gets below 1, I've got a default that I can never repay. Okay, so the PLCR of 1, if you really want to look at downside cases and how much room you have to have, that's what it shows. And now I can put it back to the base case, and I'm all back. And I hope you can do all of these things. Now, I have to press this circular reference sometimes because I put a copy paste that I hate. I hate copy paste. I hate them. I hate them. I hate them. But some kids. This is so hard to make videos during this crisis with all these people all over. Oh God. So that's the idea, and this is again something that does that. Now you can compute the PLCR over time, and what I've done in this file is I've given you kind of in the financing part of the model. And let's, of course, do the very first thing we need to do, which is the most important thing. We better color it. Now, I'm going to look at just a couple of calculations in this financing thing. I'm going to show you how I compute this default and the repayment of default, which I think is a big deal. And then I'm also going to show you a little bit how to compute some of this PLCR stuff over time and all of this stuff. Okay, and we're going to add some cash flow sweeps. So now, by the way, these red numbers mean it came from the red sheet. Okay, and so that one came from, not the red sheet, another sheet, excuse me. You can color the sheets themselves and do all of that stuff, and it colors the true falses and blah, blah, blah. Okay, now, the PLCR over time is computed over here. What you do is, just a minute, where's the PLCR over time? Here. It's the NPV. To compute the NPV, you use a sum product and divide. And when you use a sum product and divide, then you can, and this is the total debt, this is the NPV of the debt service. This proves it's the same. So I'm just showing you a few formulas in the sheet. Okay. Now, I think this is so much more interesting. Then let's talk about cash sweeps. Bankers would hate something. Here's what they would hate. They would hate that you paid yourself dividends, and then after you paid yourself dividends, there was a big crisis, and then they had a default. And then maybe the default was so bad you can't even repay the debt. Oh my God. And you investors have received some return and they've defaulted. Ooh, wouldn't that piss you off as a banker? Okay. They say a solution to this is a cash sweep. So what we saw after 2008, After that crisis, we saw bankers suddenly start to say, I love cash sweeps. Put a cash sweep in everything, even if it doesn't make any sense. I want a cash sweep. Okay, there were some real problems with cash sweeps that I'm going to show you. For me, somebody said it's like false advertising. You're telling me the tenure of the debt is 20? Ah, you're a bunch of you're a liar, because with a sweep you're paying it off earlier. It kills the IRR. Pretend you had 100% cash sweep from it. 100%. You're not getting any dividends. You're not getting any cash flow. It's a dilemma. Would you care about the way the plant is operated if you're giving every single penny of your project to the bank? Now, I think there's a gigantic mitigation of the cash sweep, and that's from refinancing. But let's show you kind of how the cash sweep works in a kind of a case without the crisis, and then we'll put the crisis in. So uh, let's first start with our base case. Okay, and there's our little base case. And then we have some parameters. We're targeting a DSCR 1.4. We've got some merchant price uncertainty of 20-year. That's a long time. We have no cash sweep. Okay. And I think we've already fixed the assumptions. That's good. Let's fix the debt again and use our fixed debt here. Okay. Everything's kind of working in our base case. Now let's put in a cash sweep. Where do I put that in? I know you can put it in because what happened to my little thing? Oof. Oh, that was bizarre. Okay, if I put in the cash sweep and if I start putting it in, notice what's happening. I'm putting in 100% cash, so we got no money. Well, with 100%. Now there's no little white area. And notice how on the graph, I'm looking at the graph, notice how that's changing. Now turn your head to somewhere else, turn your head to the IRR, and notice how the IRR is going down. It's just like having a shorter tenor of the debt. So that's the effect of the cash sweep. Okay, that's the effect kind of in a base case. Now let's pretend that we switch over and apply the crisis assumptions, and then we have a default, and we want to see if we can repay the default. Okay, if we don't put in the crisis assumptions, oops, yeah, okay, let's put the crisis assumptions in, but now let's put a cash sweep in. And with the cash sweep, we're going to use this area and not let the company pay dividends and see how it affects our ability to repay the debt over here. So if we put in I'm going to make it extreme, we put in 100% cash sweep here. You can see, I put it afterwards too, you can see how then the bank's getting paid off. Look at it again. Okay. I hope this shows you. You know, these spinner boxes get criticized all the time. Nobody likes to put these in, but I think it all is solved because we can switch the cases. Oh, in this case, we never got paid off. I don't know what happened here. We can switch the cases, and then you can see what's happening, and you can put your scenario back thing. So I'm back to the same kind of point about scenario analysis, and I'm repeating myself a little now. When I'm an old man, I'm allowed to repeat myself, okay? So here I am. Let's go back to our crisis case. And this, I just did this. Now, when you model the cash sweeps, I'm going to stop this video soon, and then I'm going to have a second video that goes through some of the more mechanical issues. But the final kind of mechanical things I want to talk about, modeling the defaults and the cash flow sweeps. And I'm just going to bitch a little bit. I can't stand it because I have not been able to make videos because I've been working on this model, restructuring this model that had 15,000 lines in one page, and they had to, every time they put a flag, they had to put 5 items in for a flag, and then they put them in a different sheet so you couldn't find them, and I can't stand. I'm sorry about this. I'm sorry about going crazy. I'm gonna. It's like I lose it all the time. If you don't put this stuff over to the left, if you put all these drivers, I don't know why I'm down here. Let's go to the financing section. Okay, I don't know where I am here. Here, the cash sweep. Why don't I? Yes, that was a bad idea here. Let's go up here to the debt sizing. okay, way at the top. These, if it comes from another sheet, first put it in the color and make it one line. So you can press the control square bracket and F5 and go back. I hate those blue line things. Okay, then if you have a flag, show if I can't press the F2 and see exactly everything when I press the F2, I know now as a user of the model that my model really, really sucks. And if I have a long formula and I have to waste my time staying up till midnight, becoming more of an asshole than I am regular because I go crazy looking at long formulas, I'm sorry I get very emotional about this. So now I can see where everything comes from in a very simple case. Press the control F5. And why don't you do this? If you don't do this kind of stuff, the only exception is the lookup function. And when you see the lookup function, you can just use the entire line and look at the right at the end. Oh my God, my blood pressure is going up. I'm gonna be exposed to the virus. Oh my God. Okay, then the next thing, please have a master timeline. Do not change the timelines all the time. One timeline, make it consistent in every goddamn sheet. My God, did that take? I had to spend days, not hours, restructuring this model. Oh, and oh, God, they went crazy with input sheets. When we have our scenarios, put it in a separate sheet. Don't screw up your input sheet by putting a whole bunch of these scenarios in there. I already talked about the F2 and that. And when you make your assumption sheet, please keep them in the same logical, structured order as the model. Don't put of course, the financing is separate. Put the things where they're really easy to use. And that's what I'm going to close with. So, I gotta take a deep breath. I went kind of nuts just now. Excuse me for that. I'm really having problems in my life anyway. But here, I'm going to do a colorization one more time. This time I won't do this. And remember, we have a little way so we can mark the dependence here. Okay, which I'm working on a little more. I've got to do a little more because I got one email on that and somebody seemed to actually like it. Oh no, Control Alt C. I didn't want to put this dashboard in, so I'm going to do it again. Okay, and my final thing is to let's go over to here. Let's press Shift F11. Let's make a little content sheet. And then let's put Control Alt C and go to the Run Table of Contents, continue and make Table of Contents. And then you can find everything. Okay, I'm kind of proud of this. I said things to check, but then we can go to our time assumptions. We click on that and go back. I can go to my revenue assumptions. I click on that and go back. And then I can go downstairs and go to my scenario assumptions, or I can go to my financial model. And I can put the debt balance and see what happened to the debt balance over here. And I don't quite know why I put the underlines here. Maybe that's okay. So that's it. And then you can put your own little disclaimer saying everything's confidential, and then won't really be that confidential. It'll show you kind of what colors you're using, and of course you can change all those colors. And that's it for this video. I've got to calm down and get my heart back in order. Okay, goodbye. Oh, I can't turn off the fucking thing.